Hi, this is Greg, and in this video we're going to talk about the new banking crisis that no one's talking about. Yes, that's right. The tremendous economic problems that we've been seeing over the last 4 months will inevitably lead to a new banking crisis, and the most bizarre thing is that no one is talking about it. And if you watch this video till the end, you're going to understand how it's going to happen and why it's going to happen. So if that's something you're interested in, stay tuned because it's coming your way. Okay, so if you've been watching this channel, you know that we have been discussing the current economic fallout from the pandemic and how that's going to affect the stock market, the real estate market, and just life in general going forward. In a couple of videos that I have produced recently on this channel, one is called Stock Market Trouble Ahead, and the other one is called The Buffett Indicator Flashing a Sell Signal. We discussed these different issues and the various dynamics going on, and in those videos and some other videos that we put on this channel, we have talked about how the current economic dislocation will inevitably lead to a banking crisis. And strangely enough, in the financial press and on CNBC and Bloomberg and Fox Business News and all of these, for some reason, nobody is talking about how the current economic crisis will inevitably lead to a banking crisis. Now, it's been a common theme on this channel where I've talked about the insane amount of money printing and the insane amount of fiscal stimulus coming out of the government that has been intended largely to mask what is truly going on in the underlying economy as a result of the pandemic. What we haven't talked about is how the current economic distress will inevitably affect the banking industry. So as a result of what's going on in the economy, the government, along with banks, because remember, after 2008-2009, the government essentially took over the banks, okay, or nationalized the banks is another way of expressing it. And so basically the banks, particularly the large money center banks, basically take their cue and take their direction from the government. As a result, the banks over the last 4 months have given mortgage forbearances all over the place to both commercial real estate and residential real estate, and largely a lot of the things again that are going on in the market have been masked or covered up. Now, why does the government do this? The government does this because they want you to think that things are going better than they actually are. And we all know that there's an election coming up, and as a result, obviously the current administration wants to get reelected, as all administrations do. Every administration does this. It's not just Trump. And in an election year, particularly, which coincided with this whole disaster, they have consistently done things and taken steps to mask what is truly going on, and these forbearances are a perfect example. There is good reason why the government has done this and why the government wants you to believe that things are better than they actually are in commercial real estate and in zombie companies, because they know that the banks have an enormous exposure to these two sectors. According to the Mortgage Bankers Association, banks hold 39% of the total outstanding mortgage debt associated with commercial real estate. The total is $3.7 trillion. So that puts their exposure around $1.44 trillion. Take a look at this chart, and you'll see on the left, it shows the total volume of approximately $1.44 trillion of exposure for banks in general, including all three categories of banks. And this is non-residential. So if you net out the non-residential on that chart, you get about 1.44 trillion. If you look over on the right, you see the percentage of total assets held by bank type. Okay? It goes, the smaller commercial banks are the community banks. Then you have the regional banks, which are larger. Then, of course, you have the large money center banks like JP Morgan. Now, just to give a little historical perspective, as a result of 2008-2009, there was something passed called the Dodd-Frank Act, okay? And this was passed as a reaction to having to basically bail out the banking system, which is what happened after 2008-2009. And what this act basically did was it tightened up and increased basically the capital requirements for banks. It increased their Tier 1 equity ratios, and it also implemented reduction in proprietary trading and other perceived risky activities such as derivatives and things of that nature. The result of all this is that the banks entered this current crisis a little over 10 years later much stronger than they entered the 2008-2009 period. That's the good news. The bad news is that historically banks always, and this is something that happens again and again and again, history repeats itself, right? And it just goes on and on. Banks always overinvest in real estate during the good times because they think real estate is a safe investment. And while this may be true in good times, we all know, and we've taught on this channel in particular, that real estate is highly cyclical, meaning it has periods where it goes up and has periods where it goes down. So on the way up, it's great. It seems, not very risky, but on the way down, banks are frequently and almost always over-invested and overexposed to real estate. Now, when you look at the banking universe, you really have to divide it into 2 or 3 sections, as we spoke about earlier. The large money center banks are generally very well run. The JP Morgans of the world, the Morgan Stanleys, the Goldman Sachses, the Bank of Americas, they are generally pretty well run. They generally have a pretty good handle on their risk exposure and how to analyze risk, etc., etc. As you go down the hierarchy to the regional banks and to the community banks, generally these banks are run by idiots. This is probably why they never learn from their experience, and they always make the same mistakes over and over and over and over again. Now you have to remember, we are at the beginning of the crisis. We're not at the end. We're at the beginning. Banks are still giving 180-day forbearances. They're still doing what we call in the industry extend and pretend, meaning that they're taking a problem that they know is a problem, the borrowers can't pay, and they're extending it into the future and just hoping things will improve. And this is what they did in the last crisis too. Things didn't improve, things got worse, and they ended up having to write down their loans. Now when banks finally have to write down their loan exposure and write down on their books and mark to market their loan exposure, it's going to get real ugly. Take a look at this chart. This chart details the different areas of commercial real estate that have shown declines. The overall decline in real estate asset values up to this point is approximately 24%. That's an average. It's done much worse in hotels, for example. It's done much better in apartments. But overall, when you include everything, including office and retail, which is extremely distressed, the situation is going to go from bad to worse, and it's going to get really ugly for banks. I did another video about a month ago called What is a Zombie Company, where I went into detail over the current trend towards zombification. That's a tough word to get out. Zombification in America. Take a look at this chart. This chart shows you that a little over 18% of all U.S. companies are zombie companies, meaning that they cannot survive without either government assistance or access to the capital markets so that they can roll over their debt because they are not generating enough cash flow to actually pay down their debt. Therefore, they're called zombies. Banks also have an extreme amount of exposure to these zombie companies, and in many cases have contributed to the zombification, so to speak, of these companies, and have participated in refinancing and financings that have contributed to their zombie status. Now, the bad news to all this is that the virus is not going away. It's here with us. There's not going to be a V-shaped recovery, and by definition, the economic distress will translate to banking distress. Also remember, we're not at the end, we're at the beginning. Okay, we're at the beginning of this. We're still at the phase where banks are giving forbearances, and the true pain has not been felt in the economy. And the reason is the government is creating a situation where we are not being fully exposed to the distress that's going on in the economy. Now, I've said in many previous videos that the incredible amount of money printing that the Fed has been doing has created a bubble in the markets. This was evident in a number of different videos that I've done in the past, stock market trouble ahead, for example. And the same is true of the government taking steps to try to hide what's going on in commercial real estate and zombie companies. And lastly, I want to emphasize that all of this, the bubble in the stock market, the behavior of the banks and their exposure to commercial real estate assets and zombie companies, it all is a tremendous risk to the market going forward. Now, when this will be recognized in the market, I can't tell you. We're entering into a September-October period, which is typically very bad for the markets when disappointing earnings come in, etc. I mean, one example is look at what's going on with the airlines. The airlines are literally imploding before our eyes. Demand is down 60 to 70%, and they're looking at laying off, potentially hundreds of thousands of people. This hasn't happened yet, but once these types of things start happening in particular industries that have been very affected by the economic dislocation, then I believe the stock market will begin to take notice, and you will see that reflected in stock prices. The countervailing force that's out there, of course, is the fact that it is an election year, and the government will do whatever it can and whatever it takes to keep the bubble inflated and to get Trump reelected. So I want you to take a look at two videos that are coming on the screen right now. One is Stock Market Trouble Ahead, and the other one is Buffett Indicator flashing a sell signal. Take a look at both of these videos, and they will expound a lot more on the issues that I have brought up in this video. And if you like this content, please like it, please subscribe. I would love you to be on board for my future videos, which will be coming very soon.